Welcome back. Nope. Welcome back to another week. How are we doing today?
Doing lovely. Got a double birthday party this weekend for my two daughters, so that's exciting. And also, as you know, in the thick of tax season and tax planning season.
Absolutely. Yeah, it's been a crazy week. I know we were just talking about that before we started, but love to jump right into it as far as things you're seeing. I know I've had a crazy week as far as certain tax planning issues or things, people did in 2021 and they're trying to figure out, how to shore up come tax time. So, I'd love to hear about what you're experiencing with your clients and just go from there.
Absolutely. Yeah, given that we both work with a lot of folks, you and I both in tech and with equity compensation, I'm sure we see a lot of the same thing. But I guess common things I'm looking for or ensuring I've reported properly are IRA related activities, specifically backdoor Roth IRAs. The forms can be a little tricky as far as the form you get from the custodian, right? Whether it's
Yep.
TD Ameritrade or Schwab or whoever. And sometimes if you're just reporting it as it appears, that can cause mistakes. Even myself, when I'm in the tax program with these transactions, it's always having to double check things. So I never want it to sound like that somebody else is always messing up. It's just a confusing thing. The reporting is a bit interesting. And I think we're always trained to follow the documents, right? As
Yep.
far as a lot of people cut their teeth preparing their own tax return on the W-2s, right? W-2s only, and we just follow the boxes, enter everything, and it seems pretty easy, which is wonderful. But then some other forms that can get you into trouble, surprisingly. So I think backdoor Roths are something I'm always double checking. And then obviously equity sales, right? Sometimes the reporting is again funky. If someone's selling some company stock or sometimes exercising options as well. How about yourself?
Yeah, I mean, it was interesting because I feel like you don't know until tax time a lot of times as far as like things that are messed up, or like a lot of times it's like people are in the dark as far as like what their liability is. And so it's nice when you do work with, a forward thinking tax professional, or, if you work with a financial planner like us, who is really kind of like doing a lot of the tax planning. I think that's something that I've tried to work on over the years, is like kind of not circumventing CPAs, but just really kind of having that knowledge so I can, skip having that intermediary. But like a tool I really like is Holistiplan. And so I've been using that a lot to kind of review returns. And so, just recently this week, actually, Holistiplan caught a pretty big issue for one of my clients. We had done a Roth conversion in 2021, basically because we had anticipated that Roth conversions were potentially going away. I don't know if you remember like them talking about the ability to, or removing the ability to convert after tax money. And so he had substantial amount of after tax money in his IRA because he had exceeded the income limit to directly contribute to a Roth. And so we had been putting it in his IRA as a non-deductible contribution. And so it just kind of made sense because a fairly large portion of the IRA had after-tax money. And so we're saying, hey, why don't we just convert this money? He wasn't in a crazy high tax bracket. And, we're also thinking income tax rates are going to go up in the future. And so we figured, maybe now is a good time. He has cash on hand. Let's convert this money. And so converted a substantial amount of money to his Roth IRA. But what happened is the 1099 from the custodian showed, they mark it as 100% taxable because, the custodian doesn't know the client's individual tax situation, right? So they don't know how much money of this is after tax versus pre-tax. And so the CPA marked it as 100% taxable. And so essentially he's paying taxes on, I think he had been making like 3-4 years of after-tax contributions. So there's probably like, 24,000 or 6 times 4, 24,000 of after-tax money that he essentially paid tax on twice. And so it's nice for Holistiplan to catch that, because it's like, well, you shouldn't be paying tax on that. But now you got to go back to the CPA and say, here's the records for how much of this is after tax. And like you talked about with the backdoor Roth, that form 8606, which is and this is why it's so important to fill that out each year. If you do exceed the income limit for the traditional IRA, that's the only record that keeps track of after tax contributions. So got into a little bit of the CPA just because they were like, oh, the custodian should, fix the 1099 and say this percentage is non-taxable, but it's like the only record is that form 8606. So that's the biggest thing that I've seen recently. So I don't know if you have any thoughts about that, as far as if that makes sense.
Yeah, absolutely. I think, as we spoke about before, I think IRA activity is tricky. Sometimes the reporting is tricky, but as you're going through now, sometimes the unwinding or fixing is even more tricky, right? Because there's tax returns, there's prior year records and prior year tax returns. There's the custodian, and then there's the facts or the story, right? Kind of what what actually transpired. So it's certainly tricky. And I think you brought up a good point about getting involved in tax planning, even though there is or there may be another tax preparer, right? Because there's the tax preparers and the EAs and the CPAs, right? They're certainly wonderful, and they're qualified and all of that. However, it's easy to overlook things, in my opinion, because of the business model, right? You can be the best in the world, but if you have 1,000 tax returns on your desk to get through, and that is the only focus, that's like your Super Bowl season, you don't have all the time in the world to be proactive, or sometimes I'll use the phrase that daydream, right? You're not getting compensated in those professions to daydream about your client situations, right? You can't say, hey, I was researching a potential thing for you, ended up being nothing, but here's a bill for $600 because it took me 2 hours, right? You can't really bill for that. It's not profitable. Sometimes it's almost like I think, again, doctors are wonderful, but sometimes it seems like they come in and they talk to you for like 30 seconds and bounce out to the next person, right? So it's almost like they're more than qualified, but sometimes the model may cause someone to overlook something, right? And so given that a lot of planners, a lot of financial planners work with a set number, a small number of clients, we have the time and the capacity to kind of get in the weeds and, like you were saying, kind of poke around these Holistic Plan or any other tax planning software. So I think that was a good point.
No, 100%. I think that's the benefit that we have, the value that we can add, is that we are forward thinking, forward looking. We can actually not just look in the hindsight, but say, you are, if we're using tools like Holistic Plan, we can look at, are you going to creep into new tax brackets? Are you going to lose deductions or credits? Does it make sense to convert in this tax year, IRA money, things like that? If you're taking a work sabbatical and maybe you're in a 0% tax bracket for capital gains, let's fill up that bracket and harvest some gains. So there's a lot of planning opportunities there. And actually, one of the things I did want to talk to you also about taxes in general, since we're on that topic, is, with the recent market declines, it's an opportunity to sell some investments that might be down. Maybe recent investments that you purchased might be down. I've seen some stuff on Twitter from other advisors who are like, tax loss harvesting, it's kind of overrated because you're just essentially, pushing off that tax bill into the future when tax rates might be higher. Because if you're harvesting losses today, yes, you might be saving some money on taxes, but you're going to have to pay that bill anyways in the future. I have a little bit different thoughts around that, but I'd love to hear if you think tax loss harvesting is something that can be useful, if it's overrated. How do you feel about that?
Yeah, good question. Good question. We're in alignment on a lot of things. We could have a nice, friendly disagreement here.
Sure.
I think, I guess first, before going into the overrated, one minor pet peeve is I think it's definitely oversold. What I mean by that is, there's some new-ish technology over the last decade, or some robo advisors, which that maybe they're wonderful, maybe not. So nothing negative about them, but around that and around a lot of the hype and the marketing, related to them, there's a lot of talk about tax loss harvesting, right? And I always found that interesting because a lot of the market they were going after were maybe, they were not going after the ultra high net worth. So let's say maybe a more younger clientele, where a lot of the folks didn't have taxable accounts, right? They had maybe IRA money and they had Roth IRA money.
Yep.
And so when the big sales pitch is tax loss harvesting, but most of the assets are non-taxable accounts, right?
Right.
You can't tax loss harvest in a
Exactly.
retirement
Yep.
account, right? So that again, a little bit of a tangent and not related to your question. So I thought there's definitely
No, the incentive there to try to
yeah,
capture assets.
oversold. So and maybe not, right? So my thought is because of all of that conversation, all of those advertisings, even it seems like for a while, half the podcasts I listen to, we're talking about, automated tax loss harvesting, right? I think it's become popular in a financial term that people are used to, and it's almost a buzzword, right? So people are always looking for it. But I think it is situational. I think it definitely makes sense in some situations, right? Depending if it's a high income year, for sure. If you want to get out of some investments and get into some different ones, right? Taking the losses is never a bad thing. It's not necessarily something that we're always seeking to do for every client in every situation. I agree, you're getting a short-term benefit, you're paying the tax down the road. So I guess you could argue there's a little time value of money
Yep.
benefit there. But I guess, the way we use it is situational. For a lot of folks, the benefit is, we'll say, marginal. But if there's a situation where it's more appropriate, where say you're in the 24% bracket usually, but now you're in the 37%, that year we might try to take some losses. But yeah, those are my thoughts. How about you?
No, I think honestly, I agree with a lot of what you said. I do think the tax loss harvesting is something that's oversold as like, a way to gather assets. And so I think in that regard, it could be a little bit overrated, but I also think there is definitely a ton of benefits to it. And I think, I've seen a lot of advisors talking about it on Twitter recently and just saying that it is something that's overrated. And I just disagree with that because, I think it depends on your investment philosophy. Like if you do have a ton of positions, it can cause complexity because, if you're switching in and out of different investments, you could be, creating like holdings that you don't necessarily want to hold on to long term. I try to keep it very simple using kind of like total market ETFs and stuff like that. So if you're only using 4-6 ETFs at a time, you can swap in and out of like, going from an S&P 500 to a total market ETF, kind of maintaining that similar exposure, but not the exact same exposure. So you're avoiding that wash sale. But I mean, for me, I just think it is a benefit because, when there are market declines and you're taking those losses, number one, you can use up to $3,000 a year off your earned income as a deduction. So there's a tax savings there. And then those losses can be used to offset future capital gains if you have no other gains to offset in a tax year. So you can perpetually defer taxes. And I understand that in theory, you could be in a higher tax bracket in the future and now you're paying more in taxes, but there's always going to be market declines temporarily. So in theory, you could always have opportunities to harvest losses. And so you're perpetually pushing off taxes into the future. And like you said, there is a time value of money aspect where you have more money in your pocket today that can then be invested and grow. So it's hard to quantify that value there. But again, if you're doing it like strategically and you're doing it in a simple way, and that's why I agree with you. I don't love the robo-advisor aspect where they have like a million positions and they're doing it all the time because that can create a lot of complexity. But if you are just kind of maintaining that broad exposure and swapping in and out of like total market ETFs and stuff like that, like I think there's a lot of benefits there. And it's not that hard to do. So, I mean, one of the cool things with like the cryptocurrency right now is when there are losses, substantial losses, right? I wouldn't go out of my way to harvest less than like $1,000, couple $1,000, right? But you can sell immediately, take that loss and buy back in immediately because there's no wash sale of crypto.
Yep.
Like I think that's a pretty cool benefit. You're like, I'm essentially making use of the downturn, and that's going to help make my after-tax returns in the future higher because when hopefully there is gains in the future, I'm not going to pay taxes. So I definitely think it's useful.
Yeah, and do you try to cap it out? Because you brought up a good point where the most the biggest loss you can take in a year is $3,000, right? And that's not overall, that's net, right? So if you have $100,000 of gain, you can take up to
Right.
$103,000 of losses, right, on your tax return. A negative 3,000 is the lowest that can go. So when you're tax loss harvesting, are you trying to get close to that three number, that $3,000 number, or in that range? Or you mentioned taking advantage of losses and potentially using it in future years. Because that would obviously throw a bring in the time value money a little more, right? So
Mhm.
so how do you approach it?
I mean, I think anytime there's an opportunity with substantial losses, I would take advantage because, like you said, you can always carry forward it into future tax years and use it to offset future gains. So again, if you're keeping it simple and just swapping in and out of similar ETFs, it's not really hard to do. So I mean, I definitely look if there's at least $3,000. Like I try to get the 3,000 just as a starting point because at least that's a deduction there. If there are more, then yeah, I would take it. But again, like for example, in 2021, there was not even an opportunity because it was so, markets only went up and there was very little volatility. So like there's some years where you're not even having an opportunity. Now, if you're doing it with individual stocks, maybe there was an opportunity last year. But if you're just doing it with, market ETFs, there's only gonna be limited opportunities. So it's not like you're doing this all the time.
Yep.
But like we know, like you on average, you're gonna have a 10% correction in any given year, even when the market's down. So there's gonna be opportunities. And I just think it's a way to kind of increase the after-tax returns.
Yep. No, I totally hear you. One item, do you see any or have you seen any reporting sticking in the tax category,
Sure.
given it's tax season, have you seen any reporting issues when it comes to equity compensation sales? Do you see that often? For anyone, for anybody listening, I think it would be worthwhile
Yeah,
touching on that. I know we see a lot of issues over on our end.
that's a good question. I do tend to defer to the tax preparer to make sure that is not an issue. We're doing a lot of forward-looking tax planning for the equity comp situation. So I haven't necessarily come across like the reporting issues, but I've definitely come across, people not, understanding certain things around how to minimize or make their tax bill more efficient. For example, like if you did exercise options in 2021, incentive stock options, and you did have an AMT liability from that, and your stock declined throughout the year, you want to make sure that you sell that before the end of the year to make it that disqualifying disposition, meaning that you're taxed on it as income, not so you don't have the AMT, because you don't want to be in a scenario where you pay AMT only to have the share price decline. So that's like those are the things that I definitely like look out for. It's more of that stuff. The
Mhm.
reporting stuff, yeah, haven't necessarily had any issues there, although I can imagine it's something to be careful with.
Yeah, no, yeah, I think you bring up a good point, right? Where folks are exercising ISOs, they may know there's an AMT bill. So I haven't seen anyone do this, by the book, but the by the book route that you're suggesting is, someone could exercise and say January 1st, and maybe have a large AMT bill they're expecting to
Yep.
pay. And then if the value, decreases over the next, 11, 12 months, they could essentially sell, and I think there might be an exception or two, but generally they can sell in December
Yep.
and get rid of those shares, and then they would not have to pay that AMT bill. And so for anyone doing their return themselves, and there's equity sales, some of the issues that we've seen reporting wise is, I guess a friendly version would be someone sells some company shares. A lot of times on the 1099 from the custodian, the cost basis would show up as zero, or it would show up as very low.
Gotcha.
And then maybe down low, maybe down like 4 or 5 pages in the bottom, there's some supplemental info, which has basically the accurate or the adjusted basis.
Sure.
So we've definitely seen issues, whether it's if it's a tax preparer that isn't familiar with this, it could be missed, or on TurboTax, right? Again, if you're just following the 1089, you're entering it as is, you might overlook it. Or I know there's features in some of these tax softwares, which are, generally wonderful, where you can
Sure.
upload your documents, right? So you say, oh, you have something from, say, Fidelity, upload the 1099-B to Fidelity, it automatically populates. It looks right to you. It matches kind of the general entry on the document. Cool, all looks good, right? But it's not picking up that supplemental info. So, the worst case would be there's no supplemental info and you need to go kind of manually do it.
Yep.
But more commonly we do see it in the supplemental information in the document. So I'd say that's the biggest one. And what that's a long-winded way of saying, when that's missed, the individuals are paying double tax,
Yeah.
right? They've already
Huge issue.
paid tax, maybe through their payroll or W-2, and then they're now paying it on the via the tax return through the stock sales. And so what that sort of adjusted supplemental basis is, adjusting out essentially the income that you've already paid tax on, right? So you don't want to 30% maybe tax is enough. You don't want to pay 60%,
Double taxation.
right?
Yeah. No, that makes sense to me. I mean, I guess I do rely on the tax preparer, the tax professional. Hopefully they're working with somebody, right? If they have a complex situation, to catch those things, right? To recognize that, hey, why is there a zero cost basis on this? I would say that the only check that I really have is like running the tax return through Plan and seeing the observations that come out of that. And, obviously if there's something where it's like, this is 100% taxable, like, why is it 100% taxable, right? We should check and make sure that the basis was reported correctly. But yeah, these things are hard. I mean, this is why it is important to, I think it's good for even the client to have some baseline level of knowledge so that they can, be informed themselves. It's just hard, like taxes are funny. It's like, it's on us to just figure it out. And if it's not reported correctly, it's on us to figure that out too, so.
Yep, no, absolutely. Fun times, and hopefully this is helpful for a lot of folks. And if not, then taxes are definitely can be boring and painful to talk about. So it's either
Yeah.
boring some folks, or it's highly informational, probably a little bit of both.
Exactly. It's helpful for me. I like just chatting about it with you. So,
Absolutely.
but yeah, I mean, we'll finish off. I guess the only thing I would say as a last topic is anything for 2022, again, maybe like as far as like funding those backdoor Roths, as far as best practices so that people can avoid situations for having to go back and fix things and recharacterize things. Any best practice there?
It's a good question. I think, in general, tax wise, items can be painful to unwind. So I like to tread lightly or tread carefully when making certain moves, right? It's fine for a lot of folks to do taxes on their own, and I'm fully supportive of it. But sometimes when you start to tread into slightly, bumpier waters, whether it's, calculating some, your adjusted gross income to figure out what IRA contributions you can make, or what Roth IRA contributions you can make, or doing your own AMT calculation, which again, many folks can totally do it, but that's just when we see more mistakes, right? If you're doing W-2 only, don't worry about it, right? If you start to do some of these other items where you're brushing up against some potential bumpy waters, that's where we see mistakes. And it's not just that there would be a mistake, which is totally okay. It's that it can be a pain to unwind, right?
Mm-hmm.
If you're doing something that could provide a small benefit, and say a savings of a couple $100 or $1,000, it might, it could take you many hours to unwind and fix. And so generally, if in those situations, try to avoid or tread lightly, and then make it up later.
Yeah.
How about
No, I
yourself?
agree. Especially, for example, if you know already that you are going to exceed the income limit for directly contributing to a Roth IRA or deducting your IRA contribution, it might make sense to wait until you can just do a lump sum contribution, so that if you are doing things like backdoor Roth, you do it all in one step, and that there's not, like you said, you're not going to have to unwind anything. So, I'd plan that into your plan savings ahead of time so that you don't feel uncomfortable, writing a lump sum check. If you're self-employed, SEP IRA, same thing. Maybe be conservative with how much you can contribute to your SEP IRA, and you can still invest during the year. But then, once tax time comes and what your total contribution amount is, you can kind of shore that up. So those are just like things as far as like best practice that I think are best to do. Cause like you said, you want to avoid situations where you got to spend your time filling out forms and unwinding things for not big dollars.
Yep. No, I think it's tough too. I totally sympathize with folks. I think there's a lot of good information out there when it comes to taxes, but it's really all personal. It's really all situational, right?
Yep.
And again, this is a small item, but as a tax nerd, you know, when it comes to charitable stuff, right? Again,
Yep.
generally, from a non-homeowner, for example, maybe a married couple, you need to donate a lot of money before
Yeah.
you can even deduct a dollar, right? Again, if you're not a homeowner, you, maybe have to, again, married couple, you have to donate around $15,000 before you can even deduct a dollar. And so that's just a one minor item where, a lot of wonderful charities would say, oh, make contributions, they're tax
Yeah.
deductible, make them, they're tax
Yeah.
deductible. Well,
Not really.
not really, write us a $20,000 check, you can deduct a little bit. Or if you have a large mortgage and you're a married couple, then yes, maybe that $50 contribution would be deductible, right?
Exactly.
And the reason I'm referring to married couples is their, combined standard deduction is what, $25,000 or something.
Exactly.
So you basically have to have enough other deductions to kind of exceed
To
that.
itemize, yeah.
So there's again, I don't blame anyone. It's confusing. It's complex. For you and I both, we've seen hundreds or thousands of tax returns, and it's just 9 out of 10 might be totally right, but then there's always a few that are, yeah.
No, I agree. I think you bring up a really good point. I think that's, maybe we can talk about this in a future episode, is like the biggest myths around planning. And that's a big myth I see. People thinking that charitable contributions are deductible when for most people they're not. Mortgage interest, a lot of times because the standard deduction is so high now, that's not deductible. So there's a lot of things that people think are deductible that aren't actually deductible.
Yeah, I like that. I like that for a future topic. We can
Myths.
we can close on that. That's a good one.
Yeah. So yeah, anything else today that you wanted to talk about, share with the audience?
No, I think it was good, informative. Always like hearing your perspective and thoughts, and it's it's fun to have different opinions too on things, such as minor differences with tax loss harvesting and whatnot. So
likewise. Awesome. Well, looking forward to getting together in 2 weeks.
Absolutely. You take care. Have a good one.
You too.